Hi, my name's Matt. I'm one of the trainers at Safety in the Market, and in this video, I want to talk about the secrets of price forecasting. Now, whether you're an investor who likes to buy and hold stocks for the long term, whether you're a medium-term swing trader, or even a short-term swing trader or day trader, I'm sure that you can appreciate that being able to predict turning points in the market before they happen could really increase the reward to risk ratio on your trades. And that's what I'm going to be talking about today. This is not one of those videos that I sign up for all too often. I love trading. It's my favorite hobby in the world. It's also my profession. Lucky me. That's one of my favorite hobbies. I'm often signing up to courses and seeing what other people learn. And people will say, oh, come and watch my free secret of this webinar. You sign up for a 2-hour event, and at the end of the day, you get 1 hour and 55 minutes of them telling you how great they are, how much stuff they own, how much money they've made, how much money their students have made, how much money you'll make if you'll only buy their course. It's nothing like that. By the end of this, I'm going to show you exactly how a price forecast comes together. There are 3 techniques that I use to put a price forecast together. Obviously, I'm not going to give you everything in a free video, but I'm going to give you one of those steps in full detail, and you'll be able to walk away and use that to begin your price forecasting journey. And I mean that. You look at the technique, and it's not difficult to apply, and it will bring value to your trading. I was trained by David Bowden, the founder of Safety in the Market. Now, when I say trained by David Bowden, I did his courses. And by the time you work through his courses, it's like David, who was a very successful trader. For those who don't know, David called the 1987 top in advance in the market. I was going back a few years. And he called the 1989 top and published his forecast a year in advance and got it correct to within a day, but he got the price right to the point, 1855, the SPY 200 futures contract. Just amazing stuff there. He went on to make a bunch of other really good forecasts as well. He'd basically retired from forecasting by the time I was a student of Safety in the Market, but his techniques still work just as well today. In fact, I used those techniques to call the top of the S&P 500, the US market, in 2020, and the double tops on the DAX that year. I predicted the price and the double top at that level in advance. I used them to call the oil crash. I called the top of the NASDAQ futures contract in November 2021. I did that 3 months in advance. And I called the low on the SPY 200 last year in October, which we're going to be looking at in this video. I did that in advance as well. Now, I'm not telling you all of this to pad my ego. I'm telling you this because none of the techniques that I used to do this were my own inventions. I learned them all from David Bowden, and he learned them by studying the works of W.D. Gann. Now, in a moment, I'll go through the price forecasting process. Before I do that, though, I'll just very quickly tell you where price forecasting fits into our trading methodology at Safety in the Market. At Safety in the Market, we follow a 3-step system in our active trader program. It's very easy to remember. We follow the trend of the market. So you've probably heard the expression, trade with the trend, follow the trend, these sorts of things. Basically, it's like the tide. If you think about a river or the ocean, basically the tide is either going out or it's coming in, and you trade in the direction of that. You don't try and swim against the current. So we follow the trend. Then at the end of the trend, there's going to be a turning point. So that's step 2. We find the turning points. We follow the trend of the market, but then we find the turning point so that we can have an idea where that trend is going to end. And then step 3, once we've done that, is to fill in our trading plan that tells us exactly where we get in, where we put a stop loss order so we protect ourselves, and where we put our profit target. So that's where price forecasting fits. It's in the middle. We don't just open up a market and start price forecasting. You can, but it comes at that second step after you've looked at the trend of the market. So that's the 3-step process, and we're going to be looking at price forecasting. Now, there's the big 3-step process. Price forecasting itself, it has its own 3-step process. And one of those steps is what I call resistance cards, which some of you would be familiar with. They're a lesson that was taught by W.D. Gann. For those who don't know, W.D. Gann was a trader about 100 years ago, very famous for his market forecasts. And Gann published a bunch of books and courses, over 2,000 pages easily worth of content there, very dense pages as well. He used to write in a very concise style. I love reading Gann. It's very encouraging, and I always feel inspired and uplifted when I read it, but it is pretty hard going. But resistance cards we're going to look at today, they are taught openly in Gann's work. And then there are a couple of other techniques as well that are hinted at in Gann's work, but they're not laid out cleanly. And for me as a trader, I can honestly say I would not have found them by myself and been able to use them. But David Bowden, the founder of Safety in the Market, in his active trader program, he lays it all out for you. So at the end of the day, There's no questions, there's no doubt. He tells you exactly what you need to do. And in fact, when I called the 2021 yearly top on the NASDAQ, which was the all-time high at the time, it was actually replicating an exact example from the active trader program that David had put in years and years earlier. So as I said, there are 3 steps to price forecasting. One I call resistance cards, another one I call ranges, and the third one I'm not going to name for you because the name of the technique kind of gives the game away a little bit, but it is all taught in full in the active trader program. Now, as I said, I've used David's techniques to call market tops and bottoms. I've been a trader for 20 years. A lot of our students at Safety in the Market have also gone on to make their own impressive calls. 2 that come to mind off the top of my head. I wasn't going to put these in, but John, one of our students, made a trade over 30 to 1 on the crude oil market. And another one of our students, Nicole, added 86% to her trading account from a single trade just using a powerful price forecast on a stock called WiseTech Global. So you can imagine, as I said, whether you're an investor, whether you're a trader, being able to call these price pressure points is a massive edge to have in your trading. So let's see how these resistance cards come together. And in order to study them, we're going to begin by going to the source, which is the writings of W.D. Gann. As I mentioned earlier, Gann wrote a number of books. The book I'm going to refer to is called How to Make Profits in Commodities. You'll also find some of this information in W.D. Gann's stock market course and in his commodity market course as well. Keep in mind, these courses had a lot of variations. In order to get all of Gann's work, I think there's about a 6-volume set. As I said, a couple of thousand pages at least of Gann's writings if you want to go through it that way. But I'm going to turn to page 34 of Gann's book, How to Make Profits in Commodities. Gann says, if we wish to avert failure in speculation, we must deal with causes. Everything in existence is based on exact proportion and perfect relation. There is no chance in nature because mathematical principles of the highest order are at the foundation of all things. Faraday said there is nothing in the universe but mathematical points of force. Every commodity makes a top or bottom on some exact mathematical point in proportion to some previous high or low level. Now, I'm going to flesh that out a little bit and I'm going to show you an example of exactly how that works. But I've given you in a nutshell the secret of price forecasting. It's all mathematics. It's all maths that you can do with a calculator. Remember, W.D. Gann was doing this 100 years ago. No calculators, certainly no smartphones or computers back then that he could draw on. It's all simple mathematics. You can do it with a calculator. And by the way, you can do this on any market. I've done it successfully on currencies. I've done it on indices, stocks, and commodities. I haven't done a lot of work on cryptocurrencies, but I believe that it works just as well on the cryptocurrencies as well. But Gann says, the movement of wheat or any commodity between extreme high and extreme low, either in a major or minor move, is very important. And by a proper division of this range of fluctuation, we determine the points where resistance or support will be met on a reverse move, either up or down. So what Gann's saying there is that after a market has put in a range, whether that's an up move or a down move, when that range is finished, and we can use price forecasting to determine when it's finished, but when that move is finished, we can then go on and run what we call a ranges resistance card over that range. And as it pulls back, we have key levels to watch for where that pullback is going to end. And you can do that on both minor and major moves. Now, before I get into the example, I'll just give you one more piece from W.D. Gann to complete this lesson on ranges resistance cards. Still on page 34 of How to Make Profits in Commodities, Gann says, range of fluctuations, 12.5% or 1/8. Take the extreme low and extreme high of any important move. Subtract the low from the high to get the range, then divide the range of fluctuation by 8 to get the 1/8 points, or 12.5%, 25%, etc., which are resistance levels or buying and selling points. When wheat or other commodity stops around these levels and makes bottom or top on or near them, it shows a change on the time period. This is the place to buy or sell. Now, in a moment, I'm going to jump across to a chart and show you the SPY 200 and the low of 2023, the yearly low, the bottom of the year. Okay, and it was on one of these resistance cards. But I just want you to be really clear on what we're doing. We're identifying a range on any market, big or a small range. We're dividing that range up and it's giving us areas to watch in the market. So let's do that now. I'm going to bring up a chart of the SPY 200. Here's the low of 6746. And it came in on the 30th of October 2023, which, by the way, was a date that I nominated way back earlier in the year in March. I nominated that end of October period for both the SPY 200 and the Australian dollar US dollar, which both made lows around that time. But we're dealing with price forecasting here. Let's go ahead and let's follow Gann's advice. By the way, here is the low. Look at the run up from that low. The market has run up over 1,000 points. Now, each point, if you're trading a single SPY 200 contract, each one of those points is worth 25 Australian dollars to you. So potentially what we're talking about here is a $25,000 move in the market. Now, let's have a look. If we look at this area, focusing on a big range, take a moment to cast your eye over the chart. Remember, Gann said to look for extreme moves from an extreme low to an extreme high. See if you can spot the range that I'm going to divide up into 1/8 levels. I hope you chose this one here. That's the largest one on screen. That's the June 2022 low that ran up to February of 2023. Now, all I'm going to do is apply what's called a ranges resistance card. Keep in mind, this is just one piece of price forecasting, but we'll put a ranges resistance card up on that range and divide it into the 1/8 levels. And there you go. You can see those 1/8 levels on your screen now. Now, that means as that top comes in and the market starts to fall away, we would watch the 12.5% level or 7,375, the 25% level or 7,221, the 3/8 or 37.5% level, which was 7,067, 50%, which was 6,913, and 62.5%, which was 6,758. Now, just looking at this one chart and this one technique, you can see that the market pulled up right on that 62.5% milestone. So we've done exactly what Gann said, and doing that, running the range over a large range in the market and breaking into the 1/8 levels, we have identified the yearly low in the market. Now, I reckon that's pretty cool, but I imagine what you're thinking is, well, what about all those other levels? How do we know that it wasn't going to stop at 12.5 or 25 or 37.5 or 50% or keep going to 75 or 87.5% or all the way back down to a double bottom? Well, from this layer alone, remember, this is just one technique, resistance cards. From this layer alone, you don't know for sure, but let's say that that's all that you had, and I've given it to you. That is the lesson right there. Let's say that that's all you had. What if you just bought each of those levels and you put, say, a 15 or 20 point stop loss on? You know, you'd be wrong at 12.5, you'd be wrong at 25, 37, and 50. That's 4 small losses. But you're right on the 62.5% level. And from there, the market went up 1,000 points. Let's say you traded with a 20 point stop loss, 1,000 points, that's a 50-to-1 reward to risk ratio. So if you buy one SPY 200 contract, you're risking $500, you're ahead $25,000 per contract. What if you bought more than one contract? What if you bought 3 or 4 contracts? What if you bought 10 contracts? That's $250,000 from a single technique and a single trade. It's food for thought there. As I said, whether you're a long-term investor or a medium-term swing trader, or you like to trade intraday, this is stuff that's worth having. And I can tell you it works on all time frames. So whether you like to trade the 5-minute chart or the monthly chart, this technique is worth having there. But as I said, it's only one piece of the puzzle, but it's a pretty good piece. Now, in order to work out in advance which of those levels it is likely to stop at, and by the way, I'll give you this one for free. On a big move like that, it's very rare for the market to stop at the 12.5% level or even the 25% level. So I tend not to watch those anyway. If I was just using that technique, I would ignore those two. Also, I would ignore the 87.5% level, because if the market gets down there, it's normally going at least back to the base or the previous low, or it's going further to the downside. So you can actually rule out some levels there, and you just got 37, 50, 62.5, and 75%. That's 4 levels there. Okay, so we apply this one technique, it gives us 4 levels to watch. And as I said, this is one technique. The other 2 techniques, you'll do something similar to this. They'll each give you 4 to 6 numbers to watch as well. And what you'll end up with is about 12 numbers. And from there, you look for the areas where the lines are coming together. So you can see these are lines on the chart. You'll add a few more lines to your chart, and each line is like a row of bricks. And where you see 3 or 4 lines all together at the same point, And by the way, the 2021 NASDAQ top, we had about 5 or 6 lines all really, really close together. But the more lines of bricks, the stronger that wall is going to be and the harder it is for the market to get through there. And what the market usually does is it will stop and turn around at that point. Or if it breaks through, it will burst through because it needs a lot of energy to get through, and it will shoot up and it will keep going. And that's why we always use stop losses in the market. Now, if this just happened, as a one-off, it's still pretty cool. But I can promise you right now, I haven't just taken the one time in history that this technique actually worked. What I've done is just shown you the most recent example, the most recent clear example that I can show you. As you can see, the market is up over 1,000 points from that low. Some other examples, if I go right back to the beginning of my trading career, you can see here in 2007, a nice 50% retracement for the October 2007 top on the US dollar yen. In 2008, using the same starting point or top, but a larger range, the market again came back to that 50% milestone. So whenever I see a range in the market, I always put this range's resistance card on. Now, as I said, I'm not giving you all 3 pieces in full detail. This is just step 1. But having said that, it's a pretty powerful step in isolation, and it is going to call a lot of turns for you. So I'd encourage you to take that and apply that to your own markets. We can look at a few more examples. In 2008, this nice, juicy monthly lower swing top on the SPY 200 before the GFC or the global financial crisis began and the markets collapsed worldwide. The market ran down and then it ran up into a 50% retracement. That's one of those levels there. It's one of those key 1/8 milestones there. Here's another example more recently in August of 2022. This was my best trade of recent times. This was the Australian dollar. I traded a short trade out of this top here and made 56 to 1 over the next couple of weeks on that market. Look where it's come in. A 50% retracement. It's a smaller range, but using all 3 of the price forecasting techniques taught in the Active Trader program, I was able to nail that top precisely to the point, and I was able to get in with a very, very tight stop loss and a very large reward to risk ratio on the trade. Now, I know from experience that some of you will look at this and say, it's too simple. There's got to be more to it than that. It doesn't work, and you'll ignore it and you'll move on. Others will say, that all looks good, but I don't know the other pieces, so it's not worth my time looking into. In my opinion, that's a mistake as well. The serious traders among you will go and test this and prove it for yourself, and you'll see evidence of it working on your markets on the different timeframes that you're looking at. Then you'll go ahead and you'll study the Active Trader program and you'll learn the full puzzle of price forecasting, and you'll start doing these for yourself and you'll start putting these calls together on your markets. When it comes to price forecasting, probably my favorite price forecast of all time was in 1992 on the British pound, the September top on the British pound. Some of you may have heard of this section of the market. This is a period where England, the Bank of England, removed the British pound from the exchange rate mechanism, caused the value of the pound to collapse. A trader by the name of George Soros, who some of you may have heard of, certainly this was all the rage when I started learning to trade in the early 2000s. People would talk about the Soros trade because that's where he made $1 billion US of profit shorting the pound. That means making money as the market falls, shorting the pound in one day. He made $1 billion in this day here where the market dropped by 10%. Now, I read about that in a biography of George Soros, but I went and I took my Active Trader program and I spent probably 20, 30 minutes, didn't take that long, to put a few things together to see exactly how that September top could have been called. And I actually put that all together into a lesson, and that's included as a bit of a bonus in the Active Trader program online training. It's called the 1992 British Pound case study. And in there, I show you exactly how the price forecasting techniques worked on that market. And it's just amazing to behold. You'll never look at a market the same way after seeing that lesson. So that's the secrets of price forecasting. It's all mathematics, it's all numbers, and all you need to do is run the numbers, put them on your chart, and then see where they all come together. And you'll have a very high probability. If you've got 3 or more right at the same level, you're going to have a very high probability of a change in trend in your market. And if you've got a change in trend in the market, what that actually means is you're getting into the move or the next move in the opposite direction. You're getting in right where that move starts with a very, very small stop loss. And if you can get into a move with a small stop loss, then your reward to risk ratio goes through the roof. And I don't know any other better way to increase your reward to risk ratio in the market. Using this approach, we teach our students to look for a minimum 10-to-1 reward to risk ratio in the market. However, as I said earlier, I took a trade with a 56-to-1 reward to risk ratio, and many of our students have had even larger reward to risk ratios than that on their trades. Again, the question that you have to ask yourself is, whether you're a long-term investor, whether you're a medium-term swing trader, a short-term trader, a day trader, whatever you do, ask yourself this: would knowing the price of the turning point in advance be beneficial to your trading? What would that do for your trading? It's food for thought there. For those who would like to learn more about price forecasting, there's two parts that I can recommend. Number one is to go out and buy all of the W.D. Gann books and courses. So he wrote about 6 books. There's about 6 volumes of Gann's courses. It'll set you back a few $1,000s US in most cases, and it will take you a few years to go through as well. But that's how David Bowden learnt this stuff and pulled all that stuff out of those courses. Or you can go straight to a teacher who knows how it's done, has done it before, and this is the most important part, is willing to teach you step by step how to do it. And that's David Bowden and the Active Trader Program. As I said, all of these great trades that I talk about that I've taken, my 56-to-1 on the Aussie dollar, calling the NASDAQ top months in advance, calling the SPY 200 low last year, all of that is just me replicating steps that I learned from the Active Trader Program. There's nothing magical in there. There's no complex calculations or trigonometry or calculus or algebra or all this maths. It's too hard. Nothing like that. If you can add, subtract, multiply, and divide, you can price forecast any market. You just need to know how. Now, if it was just W.D. Gann who had done it, or it was just David Bowden, or just me, maybe there's a case for you to say, oh, it works for them, but it won't work for me. But we have hundreds and hundreds of students at Safety in the market who have been through the material and gone on to incredible success. If you'd like to join them on the journey and work through the Active Trader Program for yourself, you can click on this link here, and that will take you through to a special offer that we have going at the moment on the Active Trader Program. That's all for this video. I hope that you've enjoyed it, and I hope that you've learned something, and I encourage you to take what you've learned and apply that to your own market. It's only step 1 of a 3-step process of price forecasting, but it is a very important part of that process as well, and I've used that for a lot of great trades over the years. So take the lesson, see for yourself how powerful it is, and if you do have any questions at all, please feel free to email us at info@safetyinthemarket.com.au. That's all for today. Thank you for watching. I'd like to wish you all the best with your trading, and if you have any questions at all, please let us know. All the best, and bye for now.